Corporate India has been bracing for sluggish earnings this quarter because of GST disruptions, sector headwinds, and hence the overall expectations from the results this quarter is running quite low, Ajay.
Well, that's correct, Ayesha, but due to low expectations, analysts on the street say that the earnings which will surprise on the upside will actually be rewarded by the market. And despite weak first quarter, the full year FY18 earnings expectations are unlikely to be changed due to sharp revival in the second quarter on inventory restocking and low base. That's the message for the first quarter this time round.
So we thought that we're going to put together a very special show for you. Earnings with ET Now, the Q1 preview. And two very special guests joining us on the show. Ashish, Damania, the CEO and Head of Institutional Equities at IDFC Securities. Also got on board with us, Gautam from Motilal Oswal. And let's start off with the discussion firstly, Gautam. There is a general view on the street that Q1 will be weak this time because of GST. What are your views on that? And do you see some of it already in the price?
I think at least from a news flow perspective, market has been fairly and more than needed warned about a poor Q1 because of GST-led destocking, because of other reasons also. Pharma as a sector has been weak, both US and India. IT can expect it to be a weaker quarter, especially with the currency and growth headwinds. Then you will also have certain other sectors which will see a good bounce back in growth, which is PSU banks and metals will continue to see bounce back in growth. I think the retail oriented, consumption oriented sectors, including retail banking, that will continue to see the good growth that has been demonstrated by these sectors so far for the last 3 years. So there would be a mixed bag there. Yes, people are expecting headline numbers to look index level to look muted. That's also to do with, I think, IT, pharma and oil marketing companies where the inventory losses will come in. So the reported numbers on a quarter basis could have certain impact of certain one-off kind of situations that might not reflect completely the true picture of economic growth in the country. I think we have to be patient. We have just been through one of the biggest reforms in the country for a long time, and we have to really see how the positive side of that impact plays through, especially on the formalization of the economy, of more and more corporates, smaller corporates coming under the tax net and the allied benefits of that. So even for the real estate sector, RERA implementation is going to start. So that will be another major reform which will have major impact on that sector going forward.
Well, with that broad picture in place for the first quarter, let's also get in our colleague from the research desk who would be through the half hour, will be telling us what exactly to expect from which sector. All my colleagues Pankaj, Tanya, Avan, Pranay, Sunita and Karunya are there with us on the show. But let's understand with IT, which has started doing well last couple of days, but it has underperformed the Nifty. Tell us, Sunita, what exactly to expect? Another muted quarter for the entire sector?
Expectations are quite muted from IT sector. Remember, this is Q1 is seasonally a strong quarter, but we are expecting a very subdued quarter this time, largely because the uptick that normally happens in Q1 is likely to be missing this quarter. Most of the companies had alluded that the financial services will pick up, but that's not happening. So that plus with the challenging retail vertical, the revenue growth will be much slower this quarter. Margins will continue to be under pressure. Remember, rupee appreciated by roughly about 3.9%. That plus with the visa costs that are normally accounted in Q1, and some companies will also give wage hikes, although some of the companies have delayed the wage hikes from Q1 to later in the year, but there will be pressure on margins. That's what is expected. Infosys, we are expecting them to tweak the upper end of the guidance. TCS, we'll have to keep an eye on the margin band. They're likely to miss this quarter. Wipro Q2 guidance will be something that we need to watch out for. As far as HCL is concerned, we are expecting that the organic growth will slow down in this quarter.
Okay, Sunita, we'll leave it at that. And talking about underperformers, the other sector has really been pharmaceuticals. While off late, of course, the news flow has turned positive for the first quarter, we're expecting it to be a weak quarter for the entire sector. The key triggers, of course, are going to be weak sales in India because of GST, the rupee appreciation, that's going to hit export margins as well, and the currency impact across most geographies as well is likely to be a dent for pharmaceutical companies. So weak numbers expected from Lupin as well as Cipla, and some strong numbers expected from Cadila, Glenmark as well as Aurobindo Pharma. And Gautam, I want to get you in here. Is the worst in the price when it comes to pharma and IT? Because data has been showing contra buying emerging in these two spaces.
Yeah, so let's separate them out, very different sectors actually. Pharma, I think from a quarter perspective, it is going to be a bad quarter. Currency, GST-led destocking, as well as tepid growth in the US market. I think all three factors coming together. Meanwhile, for the large cap pharma, R&D costs, compliance costs continue to be very high as they make the transition towards complex generics or innovative drugs. Now, this is a quarter where we will see the negative elements play out, but market has to start looking beyond this quarter and maybe beyond this year also going forward. And that's where the fun part begins, that valuations after a long time really look very good, compelling in this sector. And not only on an absolute basis, but also relative to what's happening in other parts of the market. I think we are seeing quality names at decent valuation. But you'll have to cherry pick stocks here, because you'll have to identify the stocks which will deliver growth irrespective of the challenges, in spite of the challenges that they clearly face, and stay invested there, because there's no point in having a broad brush with pharma right now, because the challenges are also there clearly. I think the other aspect there is that the smaller companies might have a size advantage in terms of delivering growth. So those are the 2 points that I will keep a watch on in pharma. In IT, we are still waiting by the sidelines and seeing how this transformation from the old model of application development, maintenance, people-driven, headcount-driven model transitions into the new model, be it digital, be it the world of cloud, of platforms, software as a service, analytics. So we are seeing those transitions happening. But because the ships are very large, they will take some time to turn. So that continues to be the hypothesis. We will wait it out. So there's no hurry as far as IT is concerned. The growth will come back eventually, but it will take some time.
In fact, one area of the market which is going quite confident into the earnings season is the financials, PSUs, NBFCs, etc. Let's get a lowdown on what exactly to expect there. Tanya, fill us in.
Well, the financials are expected to report a pretty strong quarter and a strong show across the board in Q1 FY18. If I go into specifics for PSU banks, all of them are finally expected to report a profit number after a couple of quarters wherein most of them came out with losses, specifically SBI in Q4 of FY17 because of the consolidated numbers. Now, in terms of trading gains, again, we're expecting all of the trading gains to be pretty much flat on a quarter-on-quarter basis, and the yields to have some kind of pressure because of all the MCLR cuts that we've seen over the past month or so. Also, in terms of private banks, the retail private banks will obviously perform a lot better than the corporate ones because the retail growth has finally seen demand revival, and a strong CASA growth will come in for all of the retail-oriented banks for sure. Now, which are those banks that we're expecting strong numbers from? Well, IndusInd today, SBI, BOB, we're also expecting good numbers to come in from Yes Bank, while on the weak side, we're seeing ICICI Bank and Axis Bank to continue facing some asset quality stress. Now, in terms of NBFCs, after a couple of quarters of weak earnings, at a stretch, we're finally expecting a turnaround in Q1 FY18. Good set of numbers expected to come in there because of the demand revival. Pre-GST buying as well as, strong auto growth will, is expected to aid growth. And finally, vehicle finances are also expected to report healthy asset quality. So NBFCs that are expected to shine, well, there's Mahindra Finance, all the HFCs in business as well as Shriram Transport. Those that are expected to be weak, mainly Bharat Financial and Repco Home Finance.
Very much for that, Tanya. Gautam, as my colleague Tanya was talking about a good result season expectations in a broad manner for the entire financial space. PSUs have been doing well going into the numbers. What are your own thoughts?
Yes, I think that process has started. See, from a low base, from being hit by losses in the first half of 2016, I think from that low base, to calendar year I mean, from that low base, these corporates have, PSU banks have come up quite a bit in terms of getting towards more normalized profitability. But you have to also watch the pace of progress there, because one thing, from bouncing from really low levels to a more moderate acceptable level is one thing, but is there a recovery cycle undergoing in the NPA part? Are NPAs, well, the consensus seems to be the worst of NPAs is behind us, but has fresh NPA formation stopped? Is the economy getting into a recovery cycle? I think the answers are still clearly no. So further re-rating and further earnings growth will be very strongly contingent on that too, because at the pre-provisioning operating profit level, even if there is some growth, and that growth will be challenged because of capital adequacy issues, but I believe that the real kicker in PSU banks will lie at what happens below the PPOP level, which is essentially at the provisioning line item. So that is something that I will keenly watch for, and that will be driven by whether fresh NPAs are formed and whether recovery is set in.
Let's also focus in on what to expect from the auto pack as well. And my colleague Karunya Rao is waiting by. Karunya, while consumers may be rejoicing the drop in car prices post GST, but is there reason for automakers to smile this quarter? Can they deliver the much desired earnings or not?
Well, it's likely to be a complete mixed bag. If you look at the volumes for the first quarter, most companies have come up with a mixed set of numbers. So it's really looking mixed as of now. In fact, ahead of the pre-GST, the sales have been impacted in the two-wheelers as well as the entire PV segment, because of the consumers did not have clarity as to what the rates will be post the GST rollout. So that's something that is likely to impact this time the earnings this time. In fact, because dealers were trying to destock their pre-GST inventory, they were rolling out a lot of discounts, and because the manufacturers were trying to help them, their EBITDA is likely to be under pressure because of passing on the discounts and schemes on to the dealers. Apart from that, the wholesale and retail sales are also weak because because of BS related supply constraints. So that is another a factor that could impact the earnings this time around. And companies, lastly, with high exposure to the replacement market can also see a good amount of pressure this time around. If you look at the top gainers, the companies which are likely to come out with good numbers, analysts believe Ayesha Motors is one company, Maruti, Suzuki, TVS Motors as well as Hero Motors. So these companies are likely to post a relatively stronger set of numbers. However, Bajaj Auto, again on back of weak volumes, the numbers are also likely to be weak this time around. In the CV segment, Ashok Leyland is expected to register robust Q1 numbers. And lastly, it is the replacement market again, which is going to bear the most amount of brunt of the GST transition. In fact, we can expect a decline in the sales of tire companies, battery companies as well as bearing companies. So this is what the estimates are looking like as of now.
Thanks for that, Karunya. Let's talk about a sector which is likely to come out with good numbers, and we're talking about metals. It's a global sector, doesn't get impacted by GST, and hence overall strong volume trend is expected to be seen this quarter. Even supportive higher prices is likely to drive the earnings. If you compare Q4 versus Q1, the sequential performance may look a tad weak because the prices have started coming off, but YOY number will actually be very strong, particularly companies' exposure to aluminum, zinc. Steel, of course, is a purely domestic. SAIL is a steel company, purely domestic, so not be showing a very strong numbers. But talk about JSW, Vedanta, very good numbers expected there. Tata Steel, NMDC, overall good numbers expected there. Also getting a focus on consumer space, which is the focus of this quarter, where the numbers are likely to be hit. My colleague Mubina is here to talk about what exactly to expect from FMCG, where as it is expectations are running very low. Mubina, talk to us about it.
Well, the one victim of the GST implementation exercise is certainly going to be the FMCG space, because it's a very widely well-known fact by now that there has been significant destocking exercise by retailers, by wholesalers of their existing inventory in a bid to really reduce the pre-GST inventory that lies with the dealers and retailers as on the 30th of June. And hence you are going to see some pressures come by on a lot of these FMCG companies' sales. Most on the street believe that the average sector sales will be anywhere between 5 to 7%. So we're looking at about mid-single digit sales growth. Margins will be under pressure. In fact, we're expecting either flattish or marginal contraction. Now, why I say marginal is because most of the increases in the raw material costs, the companies have identified that and they have slowly started hiking their prices. Of course, post GST, we have seen some companies reduce their prices, but that comes into effect only in Q2. But all in all, you know, the companies have also undertaken other measures like rationalizing their ad spends, rationalizing other costs, so as to maintain their margins. So yes, it's going to be a tough quarter for FMCG companies, but of course second half, most believe on the street will be the quarters and the years in fact for FMCG companies.
Okay, Mubina, we'll leave it at that. In fact, the big bull, Rakesh Jhunjhunwala, also is optimistic that the GST rollout is going to have, at best, a marginal impact on earnings for a short run. He's betting on GST plays like FMCG. He says this sector will be the key earnings driver this season.
I agree that, you know, these, but financials are about 35-40% of the Nifty. I think ICICI and the two HDFCs themselves are 25%.
Yeah.
So, I mean, earnings, see, if the things in the economy improve, earnings growth has to come. It can't be the earnings growth will not come. It will come from some of the FMG items, some of the consumption items.
Well, always bullish on consumption. That's the word coming in from the big bull. But Ajay, you track the oil and gas space pretty closely. Tell me, what can we expect there?
Well, Ayesha, you know, it's a mixed bag. If you talk of oil marketing stocks, they've already started giving up a lot of market share because expectations are running very low. GRMs will be sluggish. Even inventory losses are likely to be shown this quarter. That's why they are selling off. Whereas if you talk of IGL, Mahanagar Gas, the city gas companies are actually trading at record high because volumes are expected to be very strong. And in fact, low gas prices is boosting volumes there. You talk of Reliance, which stands out as a company. It will be able to put a steady number this time round. But at the same time, there would be some mild pressure on the GRMs. But Petchem end of the business is likely to really help or support the overall number, which is going to be very healthy. But so strong number at Petchem, but sluggishness as far as their GRM is concerned, and that will be more of an industry-wide phenomena this time around.
Well, we can surely tell you that expectations are running pretty high out of Reliance's numbers on 21st, and you can see that move in the stock price with the stock now at a 9-year high. But Gautam, oil refiners have sold off on talk of inventory losses and sluggish GRMs. Is the structural story already in the price and has already played out?
Yeah, so the re-rating bit has partially happened. Now at least we are seeing double-digit kind of P ratios, which for the bulk of the last 3 years was not there. So, but I don't think the re-rating can be said to have been completed. I think the re-rating is only taking a breather because of the concerns that you mentioned. Corporate actions as well as the correction in crude prices, which will lead to inventory losses for the quarter. So this is something that keeps happening in the oil marketing pack off and on. So as long-term investors, as patient investors, I think we continue to be bullish as long as the valuations still have upside room. And this is a rare sector in today's environment where the valuation ratios still have some upside. Most of the other sectors where the companies are very profitable, very high ROEs are there, you would see that the valuation ratios only have room for compression. So this is a very standout sector in that sense. Of course, there are fears around the corporate developments in these sectors, but to our best belief, those fears are overdone and more than priced in today.
Well, for a sector that struggled with slowing order inflows for many years now, capital goods space is expected to see some improvement in operational performance because order flow has relatively improved. Let's get in Avan to talk about what to expect from capital goods. It's a cyclical sector. L&T started doing well ahead of that. Avan, tell us.
Well, yes, it is expected to be seasonally a good quarter for the capital goods companies. So, in all, the brokerages are expecting around an 8% revenue growth for most of these cap goods companies. There will be the negative impact of the destocking due to the GST implementation as well. Margins on the whole are expected to show an improvement led by an improvement in the overall operational performance. Order intake by most of the companies, though, will be flattish in Q1. Now, if we break it up company-wise, the likes of L&T, KC International and BEL could clock a reasonable ramp up in the order growth. Cummins and ABB are expected to post better top-line growth, and this will largely be led by the domestic segment. BHEL could see losses being posted in the first quarter, while ABB, Siemens, Thermax and L&T can exhibit a very strong performance. BEL in particular is expected to deliver a strong set of earnings led by a pickup in revenues on account of booking orders at hand. Havells is expected to post a very steady set of earnings due to the Lloyds acquisition. So all in all, it's expected to be fairly decent, but the near-term growth challenges are likely to persist given the weak private sector capex, and even execution will remain a challenge, which will impact the sales growth of some of the large EPC players.
Okay, that's the expectation from cap goods, but after two very disruptive quarters thanks to Reliance Jio, can we expect a better quarter from the telcos? Sunita, tell us.
Telecom sector has been seeing disruption for last 2 quarters. If you notice that the revenue growth had declined by roughly about 5 to 6% for both Idea and Bharti Airtel. This quarter we are expecting some kind of improvement in revenues, largely because Rel Jio, which was offering free services till now, from 15th of April have started charging for their services, but it is at very deep discounts. So there will be some improvement, but it's not something to be cheered about as yet. Margins will continue to be stable this quarter. That's what we are expecting. Data pricing will see pressure. Analysts are expecting 10% decline in data pricing, although the volume growth is likely to compensate for, and revenues will see some marginal Q-on-Q improvements. But having said that, there is still expectations that Rel Jio will be launching new discounted rates or cheap handsets very soon, and that could further disrupt the market. That's something that markets need to keep an eye on. But for now, Q1 will be slightly better than Q3 and Q4 for the telecom sector that we have seen in last year.
Thanks for that, Sunita. Anish Damania, CEO and Head Institutional of IDFC Securities, is also with us. Anish, what are you expecting at IDFC as a house this quarter for the broad universe which you track, and also overall sectorally, which may stand out and where the numbers could be disastrous?
So I think it's a very well-known phenomena now that the GST disruption is going to impact some of the sectors which have large distribution networks, etc., etc. So that's a well-known phenomena. But what I would say is that commodities will still commodities, basically metals and petrochemicals, will be the ones which will have very strong and decent earnings growth. However, oil and gas segment, if you consider that as a commodity, will probably have a very sharp decline, largely on account of lower oil prices on one hand, lower oil and gas prices on account of one hand, and other one is inventory losses and little flattish GRMs on a YOY basis would mean that the OMCs also will report significant fall in profits. So in case of OMCs and oil companies, you will see significant fall in profits. In case of commodities, metals, you will see significant improvement in profit by about 20-25% odd kind of growth, which we are seeing. Autos is more or less very mixed. Most of the two-wheeler segments and car segments had seen slowdown because of this GST impact, and as a result of that, this quarter is going to be muted. So to that extent, there was some destocking which has happened. My sense is that as another quarter or two rolls by, all this destocking will convert into restocking, and that would mean whatever you lost by way of sales wholesale in this quarter will be gained in the next couple of quarters. So overall, this quarter we are expecting on an overall basis a very muted flat kind of earnings, 0.5% growth. And if you take out the commodities, you will see about a 7.3% growth in earnings.
In fact, I'm going to bring on board Pankaj Poddar as well, my colleague. He's been compiling a slew of brokerage opinion as well from Citi to CLSA. Pankaj, tell us, what is your observation on how the earnings season is likely to pan out?
As we are going into the results season, most of the top sell-side strategists are coming out with their expectations on the basis of the universe that they track, Sensex, Nifty, and what essentially sectors are likely to do well. Let's just run through a few of them. Let's start with Citi. Expect a 12% decline for Citi Universe. Positive base effect in materials as well as financials is now coming down. There was a big change regarding GST, and that can have a one-time impact on the numbers. Challenges seen in sectors like oil and gas, pharma, and telecom, according to Citi, they see a downside risk to the bottom-up analysis of FY18 numbers once the results are out. Morgan Stanley has also written their expectation, and they are expecting a strong revenue growth but a very, very flat profit growth. That's what they are expecting. They track about 122 companies and they see a revenue growth of about 12% over there. For Sensex companies, they see a 8% growth on a YOY basis on revenues and about 4% as far as their profit growth is concerned. Mahesh Nandurkar at CLSA has also made his estimates. He says that he expects a weak quarter across the board. CLSA Universe, the number of companies that they track together will see a decline of about 14% as far as profitability is concerned. More than 50% of the companies that they track will see a decline. Why is this decline? This one-off impact, according to CLSA, is largely got to do with GST, the inventory-related issues that are likely to have a one-off impact. But overall, they see YOY earnings could largely improve after the Q1 is behind, so they expect commentary to be on the positive side.
Thanks for that, Pranay, and all my colleagues from the research desk. The broad message is that this is going to be a subdued quarter with very select sectors actually coming out and delivering on numbers. To both of the guests, Gautam and Anish, thank you very much for joining us on the show. And with that, it's a wrap on this edition, a special show which we had brought to you for first quarter expectations from Ayesha and myself. Thanks very much for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.